trade inducement, lower time frame confirmation, time window. The inducement gives me volatility. Time window gives me volatility. Confirmation gives me it's ready. What this unlocks for me is if I can break even very quick, it allows me to get trades that I was wrong in. I took 3 trades in the week. All 3 of those trades went into a bit of profit and then melted on me. But I was able to either catch my 1 to 3 or those losses just ended up being 3 break-even trades. So if you are able to be wrong in the market and take no loss, maybe even walk away with a slight profit, this is a hack. Traders often think, I want to make a profit, so I need to learn more. I need to research more. I need to backtest more. I need to journal more. I need to do more. And as I've been saying for 2 years, a restricted trader is a profitable trader. In fact, the profits is in doing less. So this year I've been focusing on my first profitable year in trading was 2018. So I started in 2015-ish. By 2018, I made my first $100,000 from the markets. And this was years in the making and a grind to get there. Fast forward to 2025, I made that in 2 days. And it's crazy to think, if you now understand leverage, how to navigate life, the roadmap that I speak about, your first entire year can be dwarfed in just a couple of weeks. The insight I'm about to share, I only came to learn this 2 months ago. And it was really reassuring. I want to say almost revolutionary. And this is why I'm excited to share it. It's the probability of...
Ladies and gentlemen, welcome back yet again to another episode. As you can see, Waqar sat by me to be...
Yo, tell me though, how am I looking?
Yo, you're looking like a nice...
This is a new fit. Well, I wanted to, as you said, I'll be a guinea pig with you because I don't want to do this in front of a guest on the show. But I got a new designer style. I'm definitely not going to make it a usual, but... streetwear, blazer, collab, whatever.
It's funny because you've been called Unk on your TikTok and now you're doing something else just to be like a complete opposite of Unk.
That I need to understand why I'm getting Unk allegations in my 20s.
Yeah, it's pretty lit.
I'm still not 30 yet, but yeah.
Not yet. But yeah, I want to kick off this episode with something pretty monumental that just happened. Last week, you've had the best week of your entire career. Talk to me about that.
Okay, so there's a lot of things to actually mention that are deriving from this. Number one is I used to have this feeling as a younger trader that I need to show up every single day and show up for every single session and be there present and watch it through. And what I ended up doing was battling price action. So I would just be watching M1 and I might not be in a POI, I might not be in the trend, but I'll just look for things. And eventually when you stare at price long enough, you'll see something you like and you'll end up taking a trade. So what I've opted for in more recent years, specifically this year, I've traded less than I ordinarily would. The year prior when I was doing I'm still doing it, but last year I was more active with the public signals. I was sending a signal in sometimes 2-3 times a week on my Twitter. And I wanted to make that a performance, of display of performance where how did I behave when I'm growing the account from 0? So in those initial trades, you don't want to go into the negative, A+ only, be conservative, risk in a certain way. And then as I got to 10, 20% profit, then I started to act with more trade frequency. I introduced less prime setups. I started to introduce non-POI trades and medium inducement trades. And then as I started to reach, the 40, 50%, that's when things got interesting. So I can speak about this later, but that last year was a big year for me. And it was a very active trading way. And then this year I've taken a bit more of a backseat. So I've still been present in the market, but with a different approach, more because I've been traveling a lot more, focusing on other projects. Trading has now taken a different lens. And the approach here is just from a longevity perspective. Traders often think, I want to make a profit, so I need to learn more. I need to research more. I need to backtest more. I need to journal more. I need to do more. And as I've been saying for 2 years, a restricted trader is a profitable trader. In fact, the profits is in doing less. So this year I've been focusing on picking my battles. So then I'll come to a session and I'll say, if I'm not in a POI, I don't have a clear trend, I don't have an inducement, I'll just close my laptop and get about my day instead of sitting there for the entire day finding ideas. So when you are selective and you pick your battles, it unlocks quite a few benefits, which happened to me last month. Last month, I took 2 trades and inspired by a lot of the guests on the show, namely a long debate I had or discussion with Umar Ashraf. He was like, how are you going to size up in your trading? How are you going to grow financially if you're not willing to increase risk? So I decided this month, let me try risk profiles. And a lot of guests on the show have mentioned pyramiding, re-entry types, and there's various ways to do it. I just thought if I found an A+ setup, I'll double my ordinary risk. So on the first trade I took last week on Monday, which was my first trade of the month, which I've made videos about on my TikTok and YouTube channel. So there's full breakdowns there, 1 hour video. But that trader was an A+ setup. So when I came to the day before the session, I was like, I'm in a great POI. It's an inducement POI. It's with the trend, everything I like. And then I also saw a smart money trap and medium inducement before the key window. I'm seeing all of this and I arrived to the key window. I'm like, I've got every box ideally that I would want ticked. They're already ticked. This is a great day. I have now picked my battle. Today is the day I take action. And then as I watch through the session, which I'm not ordinarily doing, but today's the day I pick my battle, I watch it through. And then the lower time frame is developing perfectly between EU and GU. I'm seeing the divergences I like. I'm seeing lower time frame confirmations. I'm seeing lower time frame inducements. I'm seeing a narrative play out. So it's not just a checklist. It's a story in price. And that story is being wonderfully painted for me. So I was like, this is just a simple A+ setup. And I risked double my ordinary risk, which I pre-decided. And the best part is, and this is something I want people to really remember, recognize days where you're fighting price, where price is like chopping around and you're waiting for an entry and then it invalidates and then it comes back and it's all over the place, and then you eventually get in and then you're sitting in consolidation. It goes in a bit of drawdown, maybe goes up a bit into profit and then hits stop loss. These battle days you can avoid. And then when there is an A+ day, this is how it went. I saw everything play out in the key window. I'm halfway through the key window. I see all the validations I need, lower time frame, divergence, time, everything. And it's not often these things happen. It's only maybe twice a quarter I'll get everything ticked like this, which is why I sized up. When I see every confirmation, I'm like, perfect. I set my limit. I increased my risk. Stop loss is placed. It took 2 minutes to get into the entry. Once it tapped in, I was break even within 3 minutes, take profit 1 within 12 minutes, and take profit 2, my final TP, 1 to 10, within 1 hour and 45 minutes. And I live streamed the whole thing. So there's a recording, which I also showcased. This is effortless trading. I didn't have to think. I didn't have to do any psychology. I didn't have to do any risk management strategies, take profit. It was all so easy. And when the market is easy like this, you feel invincible and everything you touch feels like it goes into gold. But remember, these days exist. So when you're in those situations, when you're fighting the market and you're desperate and you're confused and you're in profit and then your retracement 50%, your profit is now half, it's a lot emotionally and there's room for things to go wrong. This one was an effortless day. And when I had that day and I walked away with $62,000, which I showcased the proof, the next day I've established a trend from the previous day. And now I am still in discount on the higher time frame. I'm chasing a higher high. So I've come from the demand area. I'm a little bit in profit. The next day is consolidating, inducing, and I'm thinking, well, I'm continuing this bullish trend. I'm just going to make a higher high. And then the next day, it wasn't an A+ setup, but it was a very good setup. So I did my ordinary risk and therefore ended up being about $25,000 thereabouts. I think it was 24. So in the end, between two trades, I was touching around $90,000. So just under 100K. But this is in 2 trades in the entire month, no losses for the month. And both trades tap and go. Break even within minutes, TP1 within minutes, and TP2 1 to 10 within hours. There's no thoughts of psychology anymore, because when you're trading like this and everything's A+, every box is ticked, it's really, really easy. And then with everything else going along in my life, it ended up being the biggest month financially of my life. And I think it's very interesting to observe. My first year, profitable year in trading was 2018. So I started in 2015-ish. By 2018, around November 2018, I made my first $100,000 from the markets, or also in my life. I made my first $100,000. And this was years in the making and a grind to get there. Fast forward to 2025, not too long later, 7 years later, I made that in 2 trades in 2 days. And it's crazy to think, if you now understand leverage, how to navigate life, the roadmap that I speak about, you won't grow linearly like people that are doing time for money, which is incremental pay rises and no passive incomes, no investments. Like, you're just going to grow slowly like this. But life is going to go like this. Cost of living, assets, houses, they're going to go sky high, but your salaries are going to go like this. Whereas in this case, if you have a correct roadmap, your first entire year can be dwarfed in a handful of years in just a couple of months or weeks or days.
I think that's really, really powerful.
I want to take a moment from the episode to remind you of Alpha Capital, a long-term sponsor of the show, a leading prop firm in the entire industry. And in the last year, they did over $50 million in payouts. That's why they are a top-ranked prop firm that's been around for years and is not going anywhere. And with the multiple step plans they have and the multiple packages that they have, there is going to be something catered specifically to your needs at the most competitive pricing. And because we have a long-term relationship with them, we are able to bring you a massive discount of 20% off all evaluations. So click the link in the description or use the code TOT to get 20% off all your funded accounts. Working with the best prop firm in the industry, Alpha Capital.
But one of the things that I've heard from Warren Buffett, I'd like to say, was he told a story of someone who's trying to do business with him, and he was negotiating a deal. And they were going back and forth discussing terms, prices. And this associate or potential partner was so easy to work with. He didn't like negotiate anything. He was like, whatever you think, it's fine, it's fine. And then when he was asked like, why are you just so easy with terms? I'm getting like a very good deal out of this. He was like, I don't care about doing business with you now. I care about doing business with you in 10 years from now. And that was a lesson I took of making sure you optimize for longevity. But this day also taught me a different lens of like, it's not just that longevity is much more important than immediate wins. It's those wins when you're so many years into the markets or into any career, into any whatever, would dwarf any small penny you try to squeeze out of your first year of doing anything. So it's so much worth it to stomach it and just optimize for years and years and years. And also just know for a fact that day will come where you'll make your entire year's worth of work in 2 trades.
Yeah.
That's crazy, right?
It's also it's worsened by the fact that what is a mindset like in your first year? You're pretty confused as a human. You don't understand life. You're very anxious and unsure if you've taken the right decision because the markets might not be for you. The markets might all be a scam. Is it even doable long term? So you're battling all this anxiety and uncertainty as well. And therefore you have a very penny pinching mindset, a very aggressive and conservative mindset. So it's a very conflicting place to be in. But when the mindset I have now is I'm a very abundant thinking person. Money flows, money leaves my pocket in abundance and comes in abundance. And that detachment to money, that feeling of like money finds me somehow through investments, through whatever, money comes to me. So then I'm not chasing the markets. And it might be very counterintuitive for someone in their first couple of years. It's like, well, if you know how to profitably trade, why would you not just trade more and trade every day and just try and go to the moon and become a billionaire or whatever? And I can speak anecdotally. I went pretty aggressive last year and I had a great year. But my best year has been this year when I've traded less, when I've looked at the charts less, because compounding, investments, business, everything comes together. And I think there is power in not staring at the markets every day and just knowing when to pick your battles and also knowing seasons. So it's not like this year is just I'm only a 10% trader anymore. It's certain periods in the markets when I know it's certain condition, trending condition, I know this is time to be hot. So then I will be there every day and I'll be more active and I'll be looking for opportunities every day like I was last year. Other times when we're in New York, we're traveling, I'm on a vacation, or I don't see the market is hot. It's just 1 or 2 trades a month and it's A+ only. And this is what I wanted to mention earlier that I'll come back to now. In the public signals, I showcased that journey. So I showcased when it was time to be hot in the market. I also showcased a single day with the MyFX book and everything where I got 3 winning trades in 24 hours, 2 of them 1 to 10s. So I walked away with 18% in a single day, I believe, or something like that. And that's a complete high. This is also an anomaly. And I showcased that. And then I also had a low period, which is on the public signals with hundreds of thousands of people watching these tweets. I took 1 loss, then another, then the comments get bad. Yeah. And then people are subscribing today and you're like, you're on your 4th loss and your 5th loss. And the people are commenting, I just found this guy and all he does is lose. Then I have my 6th loss. I'm like, this is getting brutal. I'm doubting myself. I'm reading the hate comments. People are like, man, I trusted this guy and now I blew my account, whatever. And they don't realize I'm 40% up for the year, but they just didn't find me at that point. And then I have a 7th loss. I'm like, this is getting brutal. But I remained unfazed, and we could talk about why. I remained unmodifying my strategy, unmodifying my risk, and I got out of it in the end. But I did encounter also another anomaly period, which is, yes, 18% in 24 hours, but also 7 losses in a row. And that public signal document, full journey, documents the ordinary journey of a trader where you have absolute highs, you have absolute lows, you have winning periods, losing periods, slow periods, a lot of break even. There was a period where I had a bunch of break evens. So no loss, but it's just annoying. You're just turning up and getting nothing done. But this is the reality of the markets. And then now I'm showcasing, hopefully people can see, a life of someone who has built himself from the markets, who is now an entrepreneur, business owner, traveler, podcaster, investor, all these things that I'm doing now, and how I still navigate the markets. But it would be weird, I would say, if I was trading the same in year 1 and 2 with a net worth of 100,000 versus now with 7 figures in the bank, to be trading the same way. It would be weird. So I think you evolve as a person, you evolve as a trader, and your approach to the market evolves, and your strategy evolves as you educate yourself. So it's interesting just for myself to reflect upon, and hopefully people to derive something from, an inference of how a trader's journey should look like as you navigate towards the decade.
I want to put a pin in your 7 loss streak. I want to get back to it, but something you've mentioned of like, now you've made 100 grand in 2 days. Why not just trade like that every single day? And this was a point mentioned in a book called Deep Work by a guy called Cal Newport. He's got a PhD in like something to do with like how humans behave under stress, how to be mostly productive, etc., etc. And he's got a very, very nice library of books and content around that. And his whole philosophy is you work only 4 hours per day, and you work with maximum intensity, 0 distractions, etc. And then like he addressed the comment of like, okay, if you can do this entire work day in 4 hours, why not just work with the same intensity all day? And he's like, this defeats the whole point.
It's diminishing returns.
It's diminishing returns, right? And it's, okay, what are you optimizing for? Are you optimizing for output per hour in isolation, in a vacuum? Or are you optimizing for output in a month, in a year, in a decade? So it's similarly, if you take the same approach you took, right, and you place the same limits and you do the same execution with the same carelessness and the same ease, you're not going to get the same results again. And then what turns from a 100K month can be now a 20K month, a 40K month, a 120K month, whatever.
Yep.
And
in the markets, less is more.
Right.
More is more.
And it's also the effort put in for the same result. So let's say you walk away with 200K, but you put 10x the effort to get the same 200K. So then the first 2 trades are not equal to the whatever else you made. So there's a lot of things to consider. And in theory, things are very easy to just talk about, but in reality, it's a very, very sensitive thing.
There's a couple other things to also derive from this experience.
Right.
Is number one, we mentioned how abundant mindset versus a new trader mindset is different. I also want to talk about effort. And my first 4 or 5 years of just my own journey, when I was a university student, when I started, I was a very intense person. I was doing so much sacrifice. Not only am I going through a dental degree and clinics and exams and group projects and case studies and presentations and all of the stresses of university, plus living in a new country. I don't speak Spanish at that time, so learning a language, like there's a lot going on. Plus, I'm trying to figure out how to trade whilst I have patience to trade. That's a very intense environment. I sacrificed friendships, I sacrificed socializing, and I worked obsessively. I don't do any of that anymore. And you might think, well, that's a regression in your life. You're not as hardworking anymore. And I've just understood things better now. And I'm not saying I would do things differently. I think that's what is needed in your first years, but it's not needed for me anymore because it's Naval Ravikant, shout out to his philosophies because they've educated me a lot. I now have a very unstructured life where previously I wake up every day at 7 a.m. because I got clinics and lectures. Now I sleep when I want, I wake up when I want. I don't have structured meetings. If I feel like having a meeting, I line it up. If I don't, I don't. If I want to talk to someone about something, I'll send a voice note if I feel like it, and I'll get back to them when I feel inspired again. So there's a very I'm speaking from a place of luxury, but it's changed. And this is also a personality shift. And it goes further because it ties into the markets, which is why I'm mentioning it. Naval mentioned you have meetings to then discuss, collaborate, brainstorm, and have serendipity. And then the interviewer, Chris Williams, asked him, well, if you're no longer having meetings, are you not reducing your window of serendipity, of curiosity, because you're not having these structured moments? He said quite the opposite. I said, my entire life can now be serendipity because if I feel like reading a book, I'll read it. If I feel curious to go on a walk, I'll do it. If I feel like I want to call my dad and talk about something, I will. So it's like when I have no structure, no more coffees, no more let's hang out. It's just whatever you feel like. And I embrace this now. So I'll listen to a podcast. In fact, the other day, you saw me, I'm listening to a podcast. And usually I'm listening to a very value-dense podcast. And you're like, are you finding any value in it? So I was like, no, I'm just getting entertained. And it's like sometimes I'm all in for value, all in for enjoyment. Like it's a very fluid life I have now. And I apply this also to the markets. So my approach was previously intense, all in, structured towards the markets because I'm also backtesting intensely. I'm also studying intensely. I no longer backtest. I no longer research other schools of thoughts. I refine my craft. And this is curiosity. It's like I'm observing this pattern of data. A recent one that we spoke about is how many times do I hit 1 to 10, my TP2, versus the rate I hit my 1 to 3s? Well, I'm hitting 1 to 3 a lot of the time. I'm hitting 1 to 10 sometime. But I started to realize there's an inefficiency because it's not going to 1 to 10 often enough. So now I've been thinking, oh, this is a nice observation. Let's explore it. And the exploration has been maybe on my A plus setups, they have a disproportional 1 to 10 ratio. So I'll keep that ratio there. But on my counter trend trades, on my non-POI trades, on my domino effect of minor inducement setups, it'll go over people's head, but I have a setup like that. These three, I realized they don't go to 1 to 10s that often. So I full volume at 1 to 3. But this came from just curiosity and observation. It didn't come from intense backtesting and so forth. And now also within my life in general, I'm not working as I used to, because when I have a team, it's a nice, someone mentioned about Elon Musk. He's like, he could not work for a day and he still gets hundreds of thousands of hours of work done per week without him doing anything, because there's a team there. So when you really embrace leverage, which is linear life we spoke about versus exponential life, the ability to have your entire first year of profits made in a week is only through leveraged means. And this year has symbolized all forms of leverage for me exploding. The groundwork was built years in the making, months in the making, whatever it is, but they exploded in the last 2 months, where the reason I had my biggest month in the markets, but also biggest month financially, was because I understood compounding growth and leverage, and I deployed all of them. And this month it all came together, where I walked away with just under 100,000 from the markets, but also multi 6 figures in 6 weeks.
Yep.
Without working. This is crazy. But I worked a bit, but I would say I worked the least in my life and made the most in my life without having to have stress. Because in my early days where I'm grinding, hustling, anxious, learning, late nights, whatever, I'm in a stressed state. I'm also not used to the market. So a loss feels like a weight on my shoulder. Now when I've taken thousands of losses in my life, I'm used to it. So I'm really unfazed. It's exposure therapy, it's immersion therapy. All of these have now yielded benefits for me, where I from the outside, it would be a stressed life. From the inside, my new Whoop band that you got me shows me I'm a low stress individual because I've just acclimatized and adjusted. One of the worst feelings as a trader is investing hundreds of dollars in a prop firm, earning your way to a payout just to get scammed by the prop firm. And I'm sure most of you are tired bouncing from website to website, not knowing who to trust, what are credible sources of information, and what are just marketing campaigns by these prop firms to trick you into spending your money with them. And that's why I'm proud to bring to you a partner of the show, that is Prop Firm Match. Now, Prop Firm Match is a complete and comprehensive, trusted comparison website of all of the prop firms in the industry, where you will have verified reviews of real traders who are actually customers of the prop firm. And inside the website, you have multiple filters so you can categorize the search based on your own trading style, based on what parameters are useful and preferred for you. But beyond just that, Prop Firm Match has the best discounts in the industry for each listed prop firms, so you can get everything that you need in one place. So go ahead and click the link in the description to research the best prop firm for you and find the best prop firm discounts in the industry.
Something you've said here about the fruits of your building now all just coming into fruition in 1 year. I've seen this post from Hamosi's like overnight success, and it's a graph of just small, and then a boom. And it's like, this is overnight success. It's very interesting to reflect on. Something you've said also about the whole, let's say, journey of what you described of like your best month with the least amount of effort. You've described how you are much more relaxed now when it comes to the markets compared to prior. You'd be very intense with the education. You're learning a lot of things. You're trying a lot of things. Something I want to visualize. I want to discuss with you. If you visualize on a graph your P&L and your speed of learning or your amount of learning across your decade long of experience.
Yes, inverse probably.
Right. So how would that look like, and like why would that be the case? Because you would imagine like someone with time just learns more about any profession, right?
So there's probably two categories we need to decipher. Number one is rate of learning or quantity of learning versus small insights that hold a lot of weight.
I'm more referencing the quantity of learning.
Yeah, so the quantity is like, obviously in the beginning you're learning everything, and a lot of things you're learning are useless, but you don't know they're useless, so you learn it and then come to realize it doesn't fit. Right. So that first 2 years, you're a sponge and you're intensely learning everything you get your hands on. I was deep in telegrams, finding leaked courses and doing all of that stuff. Complete sponge. Now I'm not learning as much. However, the few adjustments I make yield me massive returns. Right. So it's also a display of quantity versus quality. Here is important. In the earlier days, you will be all about quantity because you don't know what is quality. Right. Later on, I'm not going to watch other people's courses. I'm not going to learn a new school of thought that people are talking about, because why would I learn something from zero when I don't have a competitive edge. Rather, I'll take my edge that I have. It's proven, stood the test of time. I like it, I enjoy it, and just build on top of it rather than from zero. So now it's refinements and improvements and small things that come randomly. They're not systematic. Like I can't predict I'll have these 4 changes in the next quarter. Sometimes I'll have no improvements. Sometimes I'll have a couple of improvements in a month. But these small tweaks go a long way. And I've documented in the last 2 years of this show, the changes I've been doing from the profit-taking systems to now this adjustments that I mentioned. This is normal, slow progress because your progress is also going to be diminishing. There's only so much upside there is left to squeeze out. But those, those final pieces of the puzzle, the first moments are the 80, and then the last years are the 20, in the 80-20.
I think it's a very good sign for you to have as an individual also, just to make sure you're exercising leverage in whatever you do. If you have that graph of like your rate of learning and quantity of learning and amount of effort over time, and it's just either plateauing or it's going down, and your return on said effort is just exponentially growing. You know you're in the right vehicle. But if it's all the way around, then you've picked the wrong vehicle, and it's a good litmus test for yourself.
It's also another consideration that the industry you're in. So for example, if right now we were in the AI space, there might be people in the AI space who started 10 years ago or whenever AI first started, and they might be plateauing and they're just keeping up with the times. But then someone that is like, new to it, whatever, they're going to be swept away because the industry is booming. Whereas if you are someone in the, I don't know, email copywriting space, like it's useful for businesses, but ChatGPT and Claude, they can make a lot of novice copywriters redundant. Right. So you're in an industry where it's very easy to plateau. So in the markets, you might think, well, as you get more mature, you will plateau. I think that's a natural curve for anyone, but you still fight for progress. And the way you will really have jumps in the plateau is going to be through capital. If I can now access another $1 million and put that into my account, I can now have the same trades but get more out of it, same inputs, greater outputs, because capital was put in the middle. But I think plateauing in the markets is not a problem if you know how to use your profits to then have other curves that intersect with it. What I mean by this is, if my goal in life was just to keep growing my account and just grow it and grow it, and 5 years later growing it, 10 years later growing it, and just pulling out profit of what I want to spend on. This is the trader's dream and the trader's norm as a vision. I think it's flawed. I think what you need to do is not try to go from like 100K to 1 million to then 10 million. How about you just get to 1 million and you realize 1 million is powerful, and then anything surplus to that, withdraw it and put it into the stock market, put it into the property market, put it into business, put it into private equity. These are things that a lot of people are not familiar with. I was also not familiar with it, but I'm learning a lot right now with ChatGPT. And just the other day, I mentioned to you, I learned how to do a full tax efficient corporate structure, IP protected, legally protected, how I should have my assets structured, all with ChatGPT. And that kind of consulting from a tax advisor or a family office, it would have been thousands. Right. But I educated myself, and now I can look to take action. I think as a financially mature person, you have to build wealth and understand there's a difference in wealth and rich. Rich is someone that has a high cash flow and they take their active income and they spend it on liabilities, which is every trader we see online. A wealthy person's approach is, I have a high income and I take that high active income and I put it into investments. Those investments generate me passive income. Those passive incomes I can now throw into liabilities. So it's that extra step in the middle, which is why I didn't do the fancy car when I made my first million. In fact, if I look around in my life, the liabilities that I've spent on have been this year. Prior to this year, I didn't have liabilities aside from vacations and rent. And my rent was not crazy in terms of beyond my means. But now that I've set myself up in a good way, investments are there. Now that the money is coming back to me effortlessly, I'm not working for it. And the last 2 months have been a showcase of that with the stock market. The ability for me to make multi-six figures by doing absolutely nothing and then put that into a liability, like there's no harm because it's just going to keep coming. And this is wealth. And I wish I started younger and I wish I knew about this younger because I would be in a much stronger position. But educating myself and for everyone to know, it's really important. I
want to put a pin in that. I was going to touch on it again towards the end, but I want to refer back to one more point regarding progress as a trader with P&L in mind. If we now plot a different graph, right, to plot your journey as well with P&L over time, and something else now, you've had quite the journey in your trading. You've started off, you've done a bit of harmonics, done a bit of Elliott wave, a bit of SMC period, God forbid. a bit of swing trading, and now just a liquidity, more even anti-SMC trader. And
One more to add in there. I started off with Ichimoku Cloud. I don't know if you're familiar.
right, you know,
That was a mad one. Like 10
I'd love to
indicators
see your
combined.
charts, right, when you're trading.
You'll be blown away. It's like,
So let's say you've got like, you're juggling all these schools of thought, right? I want to plot now your conviction in your strategy against your P&L. So let's say I've got this new edge, and this is the shit. This is going to be making me a millionaire, right? How is that reflecting in your P&L? And as your P&L grew, how did that belief change?
yeah,
with time?
conviction grows pretty nicely as a mirror image to P&L. Is just conviction is probably lagging, I would say. Like the P&L comes and then the conviction comes a little bit after that. So certain times you will be making profit in the markets and you'll have the gut feeling that this is probably short term and just on a lucky period. And that's where the space is, or the delta for imposter syndrome, I guess.
Right.
And I think that's very normal for a trader because we are not taught these things usually. I was not taught my current strategy.
Right.
I learned foundations and then refined myself based on my personality, based on what I want to optimize for, and have this unique approach in the market. And I think everyone has their unique approach based on their own cocktail of information. But when you have your unique approach and it's working in backtesting and you're starting to work in the real markets, you still feel like, I don't know if I trust it. I don't know if this is going to work. And when you see, oh, it's still working. Oh, it's getting easier. Oh, my losses don't hurt me as much anymore emotionally. I'm putting less effort into it and it's still working. In fact, it's getting easier and I'm making more and my life is also flourishing because I'm taking that profit to invest. So this is another benefit. When I've seen my stock portfolio make X hundreds of thousands, I don't feel any craving to trade. So for me to now execute upon only A+ setups, in theory, is excellent. But I've also told myself that last year, I'm only going to do A+ setups. But then when you see a decent setup and you've sat there for 2 weeks and you're not taking a trade, to maintain sitting on your hands and take no action, yet you show up every day and yet you look at the charts for hours every day, to still not take action is very difficult.
Right.
To exercise the restraint or willpower to not take a setup when you told yourself only A+ setups, but the A setup has a positive win rate. It has a worthwhile consideration, and not take it is very difficult. But when your businesses bring you X and the stock market brings you Y, and you're seeing your real bank account jump, then there's no craving in the market, and you're able to exercise your protocol in the market, which is why people always say, if you've got money problems, go get a job because it'll make you a better trader. I'll say that again. If you've got money problems, go get a job because it will help your trading. Whereas people try to solve their lack of money through the markets, which only amplifies emotions and leads to a detrimental outcome.
Touching back on that point of conviction and switching trades and having that as a lagging indicator behind your P&L. So your P&L improves, like you've mentioned, it gets easier, better reward, and your conviction is now catching up. I think it's pretty insightful because we had a poll on our YouTube channel a couple of days ago of like, what's holding you back the most as a trader? Is it your risk management? Is it your trade management? Is it something else? And hesitation was a part of it, and it was by far the majority of what people were. Hesitation. Just like not even being fully confident. Like if I don't know if I should execute on this. I don't know if it's whatever.
What were the other options on the poll?
It was risk management. It was trade management, and it was psychology and hesitation.
And hesitation beat psychology.
Hesitation beat. Yeah,
I would have guessed psychology. Okay.
I would have guessed too. I'd just put it there as like maybe people are hesitating.
Psychology is usually people's main scapegoat, but I think this is pretty insightful because they are taking hesitation as a form of psychology, which it is. I don't trust myself. I don't trust my data, whatever it is. It's a psychological component, hesitation. Right. But it speaks to the idea that why would someone feel hesitant if it meets the strategy and they hesitate to take the trade with risk management in place, with systems in place? Why would someone hesitate? It is.
I guess you just don't have enough data for you to know to back that strategy because things are good on paper. But then once it's exactly like you've mentioned, like once you've seen it work out for yourself, less effort, more reward. Oh shit, this might be working now, and then my conviction and less, therefore hesitation goes down.
And that lag in the initial years is very long.
Exactly.
The lag now, I don't know if I even have a lag, but in the beginning, it's a 1 year, 2 year lag.
Right.
So there's a lot of space to just doubt yourself and probably give up. Also within the hesitation, it's not hesitation in the data. So it's not like, okay, backtest more.
It's an execution.
People are backtesting and journaling, and people always say, I'm trust me, bro, I'm backtesting 12 hours a day. Okay, I'll assume you're telling me the truth, but they'll still hesitate because there is a gap between back testing and emotionless trading, and then forward testing, which is trading the actual market. The gap there is real emotions, and that's when your hesitation is amplified. So I think to overcome it, if I'm to think about it, it's going to be simply executing over time. There's not a shortcut. I think it's just years in the game. And there's, taking a month of intensive where you're like, I'm going to take 100 trades this month. I don't think you'll arrive to a more confident place faster. I think it's just years under your belt.
I think it's like you mentioned, you don't have to wait for the confidence or for the perfect setup or for the perfect day. You just execute. It's normal to feel hesitation because it's a lagging indicator. And that's kind of the key takeaway. Now, going back to something very interesting, which you've touched on a bit earlier on your public signals, right? So you show up to the market and that happened for how long was that period? Like, is it several weeks? Was it
the 7 losses?
Yeah.
So it was in an ordinary cadence. I was probably doing 1 to 3 trades a week on my public
So
signals.
was that like across like 3 weeks total, for example?
But when I started to approach loss 4 or 5, let's call it, what's the word? Not stage fright. Performance anxiety, let's say. Where I was even more hesitant to give out trades. So in private, I was still taking a couple of trades and they were profitable. And I was like, this is a bummer. I'm not even going to post it because it just looks like I faked it. You when you don't post the trade, you win.
Right.
So I was like, forget it. I just won't even talk about it. But this is showcase as well. Like, stick through your edge because we'll get onto it. The probability of 7 losses in a row becoming 8, becoming 9, becoming 10 is getting less and less likely. Like, it's not normal to have 20 losses in a row, but it might be normal to have 3 in a row. So there's data there. But because I had this, like, man, some of these signals, tweets, they're getting 200,000 views. And a lot of people are losing with me, and my reputation, my neck is on the line each signal. Despite the 1 year performance, I'm judged on a trade by trade basis. So the spotlight's on me, and 6 or 5 losses in, I'm feeling it. And then that leads to a bit of performance anxiety and not showcase, all of that.
Right.
So then I probably didn't post a trade for 2 weeks. I was like, I'm just going to wait. And then eventually I post it and it's another loss. I'm like, for God's sake. And then I have 6 losses in. And then I think I waited another week or 2, even though I saw good opportunities.
Right.
And I just didn't take them, or I didn't show them on a public signal. And then that 7th loss as well came. And then eventually the 8th trade became a win. And then slowly built back my confidence. Also, just the power of risk reward, by the way. Those 7 losses in a row probably took me 3 or 4 trades to get out of the hole. So it feels like a hole. You're 7 losses in a row. You're maybe 7% down to where you were at the beginning. But with a positive risk reward profile, it's not a long hole unless you prolong it yourself, which is unfortunately what I did. But I learned from it.
Yeah, that's kind of leading to my question of like, so you show up to the markets, you take a trade and you publicly signal it and it's a loss. And then once more, and then once more. And now you've done that 6 times. You show up again and this time is going to be different. I'm going to put it again. I'm going to be extra careful and it's another loss. What was going through your head? And did you like doubt something? Maybe when it comes to the edge, when it comes to whatever?
No, I didn't doubt my edge. That's not a feeling that comes to me. It was a feeling of, what the fuck? It was more just that. I didn't feel like something's wrong. I didn't feel I wanted to blame my psychology either, because I didn't feel like I was taking reckless trades. Every trade made sense to me. But it helped, the public signals helped me because I had an extra layer of qualifying, because there is no concept of like, let me YOLO a trade, let me just jump into it. Because I'm never gonna, if 5 people are watching me, I might throw a YOLO trade. When 50,000 people are watching me, I will check 4 times and hesitate and double check and think about it. So if anything, it makes me more conservative, which helps. So my psychology was fine. I took a cool off period. I took 2 weeks off to say, okay, let me just come refresh so I don't feel the burden of this. I also turned my notifications on Twitter off just to not expose myself to unnecessary comments that will make my performance worse. So I think everything was fine, to be honest.
Would you not say there's a specific thing that you was like, this was the main reason behind it, or was it more related to?
No, I think it was just. I mean, now looking back, I know the answer. If you want me to touch on it,
yeah, that's kind of leading to the next point of like 7 losses in a row. There's the I think also one of the debates that we've had on the show of like, now how do you crawl back out of a losing streak and you size down and you.
So let's touch on it. I'll pull up the table just so I can reference it better.
Yeah, I think we also display on screen for viewers. I find this, to be honest, one of the most powerful and most, I think, ignored data points that traders don't even pay enough attention to when it comes
Facts.
to.
Let's talk about it. So you'll have it on screen. So my win rate on the public signals was about 60%.
Right.
But my win rate is not static. So first I want to clarify, win rate is not a how good you are or ego metric. It's not a performance metric. It's a what you choose it to be metric, contrary to what I believed. The analogy I give is someone that goes to the gym. The stronger you are, the better your nutrition is, better your sleep is, better everything is. Your bench press strength will slowly go up. So the better you are, the better your performance. In the markets, the better trader or the better trading you do does not mean better win rate. You can have a great performance on a 40% win rate in certain scenarios. So when I realized I choose my win rates, which last year I was more than aware of because I started my public signals with A+ setups only. These carry about a 75% to 80% win rate, but they're few and far between.
Right.
It's one trade every 2 weeks. Yeah, it's a low trade frequency, but I'm building a buffer.
Right.
Now, when I've got the buffer, I've got 10%, 20% profit, I can now enable even my worst setups. Now, there's a difference between a bad setup and my worst valid setup.
Relatively bad setup.
Yes, relatively bad setup. So my worst setup that I'm willing to take carries about a 40% win rate. We're talking non-POI trades or medium inducements in no man's land, for example, an Asia range sweep only. I have criteria on my C+ setups. These carry a 40% win rate. But therefore, you can realize, but some of my trades are 80%, some of my trades are 40%, and my 60% win rate on my public signals was a cocktail of everything. Some of my trades are 50, some are 40, some are 80, but then it's weighted as well. If I took loads of my 40% win rate trades, that's out skewing the data.
Right.
And if I only took a handful of 80% win rate trades, then your win rate is going to move.
Right.
So how do you approach this? So when I realized I've taken these insights that I've spoken about just now, I was aware of last year. The insight I'm about to share, I only came to learn this 2 months ago. So it's crazy, 9 years into your journey, you still learn something new.
Yeah.
But I learned this and it was really reassuring. I want to say almost revolutionary, and this is why I'm excited to share it. It's the probability of X successive losses within a 50 trade period. Oh, this is a different table. Hold on. 50 trade also works, to be honest.
Yeah, both work. For more context with the viewers, I think this is a rather important data metric because it doesn't just say like how likely you are to lose, period, that's your win rate. It's also how you're likely to lose 4 times in a row, 5 times in a row.
Yeah.
And then when you're on your 5th loss, you have something now to refer to, like, yeah, my next trade being a loss is now X% likelihood, which is what I was going to explain now.
So I actually mentioned 2 videos ago that we did on this channel, a internal podcast, whatever you call it. I mentioned this idea of like, you should know your data to the point where you should know how often in a year you can take 4 losses in a row.
Right.
I said something like that word for word, but I was aware of it vaguely. I knew my personal data, but I didn't do this table matrix. So let me share it with you. Probability of X consecutive losing trades within 100 trade sample size. So based on a 60% win rate, which is what I have on my public signals, the probability of 7 losses in a row was 7 losses in a row, 60% was 14%. So actually that's quite unlikely, but at some point it can happen.
Yep.
6 losses in a row was 32%. That's pretty much gonna happen. And 5 losses in a row has 80%. Now that's like a certainty almost. Within 100 trades, you will have a 80% chance of having 5 losses in a row with a 60% win rate. Now let's move it to a 40% win rate, which is some of my setups. If I'm to sustain this, the probability of 7 losses in a row is 99%. So my 60% win rate is not me. I don't identify with 60%. I was aggressively doing more and more lower quality setups because I had a 40% buffer. So initially I was doing 1 trade a week, 1 trade every 2 weeks. Right. At the height of this, when I arrived to the summer of 2024, when I was just before my 7 losses in a row, I was taking 1 trade every 2 days on my public signals. So my trade frequency is high. My chosen win rate has come down because I've introduced my 40% win rate setups. So when I'm referring the kind of setups I was taking, they are more in the category of 40%, 50% win rate. And I look at the table, I'm like, there is a 93% chance I will have a 7 losing period, 7 losses in a row, 93% chance. So when I look back at that time, yes, some of my trades were still A+ setups. Some of them were 40% setups. But basically, the data is showing me there's like an 80 to 90% chance I will have 7 losses in a row at some point. So when that happens, number 1, should I be surprised? Absolutely not. Number 2, what should my behavior be thereafter? So my behavior was cool off. And when I analyze this table, I think that is a correct inference. Cool off.
Right.
Because you are unable to act in a clear way. So you will take irrational trades. You will take non-trade model trades.
Right.
And that's going to worsen your data, or it's not factored into this data.
Right.
So you cool off emotionally. When you have a level head, which takes a week, probably 2 weeks, for me, it was heightened because of the social media sphere.
Right.
But when I've now cooled off, I approach the market again and I can decide, do I do ordinary trading? Do I do aggressive trading like I was? Or do I revert back to A+ setups? And what do I do with my risk? These are pressing questions. And when everybody encounters a 7 loss period, because when someone has a 90 to 80% chance of having 7 losses in a row, everyone watching this, no matter if you have a 40% win rate or 80% win rate, majority of you guys have that win rate, you will have 6 losses in a row this year. It's just bound to happen. And write in the comments if you do. When someone is encountering this, the protocol I think is best practice is you look left, you look right on the table and you realize with my 50% trade models, the chance of having an 8th loss or a 9th loss, we're talking 30% chance, 16% chance. If I go to my A+ setups, this is where it gets powerful. With an 80% win rate to those trade models, the probability of having 8 losses in a row is 1%. So now, if I've had 7 losses in a row, which has a high degree of certainty, we're talking, what did we say, 30%,
Right.
that is going to happen. When you have that 7th loss in a row, why not go to A+ setups, which probability says is not an 80% chance that it's going to be favorable. You might be pushing 90 or 95 because the probability of X losses in a row and keep going in a row to 9 losses in a row is very unlikely.
Right.
So your relative win rate or recent win rate might be improved just on rolls of dice of chance. And then the question is, if I revert to my A+ setups, should I increase my risk now? Because now I can be more confident in the trade. Plus this matrix is giving me more confidence in data. Should I risk more? Should I risk the same? Or should I risk less because I've gone on tilt? I'm feeling emotional. A lot of people reduce their risk in the losing period. I've had the debate on the show with many, and I've said, I don't reduce my risk. And a lot of traders say, no, you need to cool off. You need to whatever. And they didn't have an answer. I took it at face value. Now, when someone's going to say this to me, I'm going to just pull this up and say, okay, if your probability of your next trade is abnormally high to be a win, despite the losing period, if now you take that win and now you're doing half risk, now it's going to take you double the time to get back out of the hole. So let's say 7 losses in a row, you're now 7% down. Let's say your average win is 1 to 3. Now, for you to get back out of the hole, it's going to be 2 winning trades or 3 winning trades. Let's assume you have a 50% win rate. We're talking 6 trades, a couple of losses, a couple of wins. We're talking, 6, 7 wins. Sorry.
It wouldn't even be 6, 7 trades because then the probability of these following trades being a win, it wouldn't even be 50%.
It's probably increased. It's true.
Probably be like 3, 4 trades.
And maybe you take 1 or 2 losses, so you go back down a bit, 1%. So we're talking 3, 4 trades to get back out of the hole.
Right.
If I now half my risk to get back out of the hole, is 8 trades.
Right.
And now you tell me whose psychology is worse: the guy that rebounds in 3 to 4 trades and it's like it never happened, or the guy that reduces their risk. So per trade, they don't feel as bad. But now you're in drawdown on your P&L for a month. That is a lot heavier emotionally. So I would argue it's more detrimental to reduce your risk in trading in a losing period, which is crazy. But the maths is mathsing. This is what it's telling me. So now I can now reaffirm my choice in my trading, which is in a losing period, I don't reduce risk, because why would you if the chance of an 8th loss in a row is 1 or 2% or a 9th loss in a row is 0% chance? You might as well keep your risk. Don't size up for the factor of emotion, because the data is saying risk up because your next trade is more likely a win. You might as well get out of the hole in 1 or 2 trades. I would argue you got to balance your emotions with the data, and the middle ground is maintain your risk. And it's a huge insight, and I'm very happy to share it. It's not my insight, it's on Google, but very powerful. Very powerful.
I think there's an even more interesting bit that I found particularly interesting myself of like, if you have a 50% win rate, and the simplest way you can envision this is a coin toss, you will have heads happen several times in a row, even though it's a 50% thing. And it wouldn't be always, and it wouldn't be 1, 1, 1, 1. It would alternate. Yeah. And it's not just like it may happen. You can check on that table, 50%. The chance of you having 4 losses in a row is 100%.
Yeah.
So
at
like,
some point
in a 100 trades sample size. So let's say in 100 trades, you will certainly, absolutely fucking going to have 4 losses in a row. That's just something that's to be expected. And you don't be like, oh, now I'm going to have a difficulty with my psychology. Oh, I'm going to have difficulty. Oh, I'm going to change my edge, whatever. Having that as a frame of mind as you approach trading, I think is very useful and very helpful for you to now have this experience and be like, yeah, this is going to end soon. and because I trust that the coin is not now like different. And I think the context of changing risk is applicable in one context. You deviate from the plan, which one gentleman we had on the pod in New York, James Thorpe. He was telling the story of how he lost an abnormal amount of money in the same day, and then his instructor told him to have a very small risk, try to make 50 pound, build back your confidence. But this was because he deviated from the policy of the trading floor, from the edge that you've got.
So it's also interesting, just that example for a moment. In that same situation, he faced a fight or flight moment.
Right.
He had a catastrophe. He went until lost so much money in a day, and he went into a flight. He paralyzed himself and wouldn't take a trade for a month. So his instructor told him, just take the smallest lot size you can and make $50 to build back your confidence.
Right.
I, on the other hand, I wouldn't go into flight mode. I'd go into fight mode. I'm going to fight the market and make it back today. So I think based on your personality, you know which side you are and what you should do. But
yeah, the point here in terms of data as well is like, as long as you're on the plan that you've backtested and you know for a fact has X% win rate, for example, the coin toss, you should not be in any way considering sizing down or doing anything different because the coin has not changed. Now, if the coin has changed due to psychological information or psychological factors where now you've added some 20% win rate trades into your catalog, now the data is not even in your favor anymore. And now sizing down actually makes sense because you've just skewed. And I think also sizing down makes sense as long as you now establish your position into the plan. So you're not sizing down in wrong trades as well, because that's not going to help you. So I think that's also a powerful take that I took myself.
That's probably a very tough conversation someone has to have with themselves of
Right.
when they go on tilt, they think they're following the plan, but realistically, if you are not following the plan, you might end up taking trades that are 30% win rate, 20% win rates. And therefore, if you're going to deviate away from the plan, just don't lie to yourself and say, okay, when I go on tilt, do I start taking crappy setups or not valid setups? If you are doing that, probably then size down. But if you're someone that knows your trade models and you're deploying them and you're following the plan, it's just getting loss after loss, realize it's normal. 7 losses in a row can actually be very normal with healthy win rates. But that 8th one and that 9th loss is pretty unlikely. Maintain your risk because you're not going to spend 1 month in the hole that you would if you followed the plan and reduce risk. So follow the plan, maintain risk because the probability gets in your favor. And then if you just skew it towards a rigged game, which is you now pick your 80% win rate, your A+ setups, there is almost a certainty your 8th and 9th trade will be wins.
Right.
So therefore, if you maintain risk, you can get out of the hole in 2 trades, which is then a losing period doesn't turn into a tilt, it turns into a quick rebound. And then that's powerful to know. As a trader, it's very simple. You have to find an edge and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZella is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your back testing tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting it on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need, the correlations that the AI within TradeZella is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZella website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it, and probably you'll be using it for years to come.
Now, on the topic of data, there's something also interesting where we've recently been using these whoop bands to track our health and get more data points on how the body is reacting to certain things. And you've said something pretty interesting to me of like, your parents got the same thing, but they look at it as like, just my sleep score. It's pretty useless. But when I showed you my dashboard and how I've been using it, you'll be like, this is very similar to trading in terms of like the amount of data and the types of data you gather are going to help you actually understand what's going on.
Yeah.
And therefore, it's the correlations and the thing you focus on when it comes to data that become useful and help me draw correlations of like when I have these days or do these habits that affects my body in this way.
Right.
Someone else using the same tool, getting the same data wouldn't be able to do that. Now, reflecting that on trading, what do you think is the most worthwhile data points for you to focus on if you want to have actual practical insights in your trading?
That's a nice question. So first of all, not to make it sound like an ad for TradeZella, but your Whoop band collects so much data.
Right.
And my parents' utility of it is like they wake up, they refresh it, they look at their sleep score, and that's it. And they're like, okay, today was an 80, today was a 40, whatever it is.
Right.
But it didn't change behavior, it didn't give any insights, and it didn't use the potential of the data that was taken.
Right.
A lot of people can go to a TradeZella or a journal platform and see, okay, this is my win rate. My FTMO account also tells me my win rate. So what is the benefit of this?
Yeah.
And then they cancel it.
Right.
And then what they don't realize is within TradeZella, not even talking about all the other features of backtesting and all of these things, it's just if you input the data, which there's some manual work, but so is with the Whoop band. You gotta feed it information and then also read the reports it gives you. So if I'm not entering on my TradeZella, if I'm just syncing into my broker, it's uploading my trades, but I haven't given it hashtags of like, this is my A+ setup, this is my B setup. How are you going to get inferences on your setups if you haven't inputted your setups?
Right.
If you don't even have setups or playbooks. So you got to input the data in to get the most out of the tool. And then once you have done that, to be honest, I'm looking at the key things, which is win rates, average risk to reward, the break-even rate, how many trades reach take profit 1, how many trades reach take profit 2. So now it's no longer a static win rate. It's a win rate in reference to TP1, TP2, break-even, and loss. So let's just call it a dynamic win rate. An insight that I had 2 years ago with TradeZella was I didn't realize that break-even, I've said, has no cost, which is true. Break-even has no cost. But I was trading a large size, and I realized 1 month my break-evens had cost me $16,000. So I was like, what the fuck? I didn't even consider this. I was like, how? Because you just see a P&L at the end of the month, or you just scroll on your MetaTrader and you put in the dates you want. You just see a number. It's like, I'm up or I'm down. But I didn't consider this hidden tax in break-even or in the markets, which is the cost of spread and the cost of commissions. Your dollars per lot size placed.
Right.
So because of the trade sizes I was doing, I have with my broker $7 per lot in commission in fees just to place a trade. So if I'm placing 100 lots, I'm paying $700 in fees. I wasn't considering this foolishly, and I didn't consider. I have a raw spread account, but at times it might be half a pip, 1 pip. So if I'm, if I'm doing X amount of dollars per pip, it's an expensive pip that I'm not considering, plus the $700 in commissions. So this tallied up, even though I was having, let's say, 10 break-even trades, I was doing a flat break-even. So I wasn't breaking even, considering I need to be a little bit in profit for the spread and for the commissions. So now I just add 2 pips or 1.5 pips. So my break-even is actually ever so slightly in profit to factor in this hidden tax.
Right.
I would not even known this, and I hadn't known this for 7 years of profitably trading. So what was it, 8 years of trading, 9 years of trading in general. And so 8 years of trading in general, and I hadn't even considered the cost of break-even is something, unless you move your break-even in a specific way.
Interesting.
But this is an insight. So a lot of the insights you will get are inferences you would have never imagined with the inputs. Just like you mentioned, one of the insights you have is when I have an afternoon snack, I have better sleep. You just would have never thought to think about that. It's also a random insight which you uncovered. So you will uncover a lot of random things. There was a period of like 6 months in 2023 where buying on Thursday was heavily unprofitable for me. So if I just remove that day, my P&L would jump, my win rate would jump, everything would jump. But now I got to ask myself, because people see that, people say, I don't trade Mondays. I'm like, why? It's like, Mondays are not profitable for me. I don't trade gold. Why? Gold is not profitable for me. No, gold can be profitable. Mondays can be profitable. But if I'm in a bearish market and I'm buying on Thursdays, then of course it's going to be not favorable. It's a bearish market. I'm counter trend trading. So I just realized there is a window of time where counter trend trading or buying on Thursdays was not profitable for me. So I removed it. But I also figured out I shouldn't remove this forever. So then I continue to back test, or let's say paper trade these Thursday trades. And then when I started to realize, okay, I'm now in a bullish market, or I'm now in a certain market condition, buying on Thursdays is now appropriate. I reintroduced it. So some of these data points are just insights that you will not uncover, and you modify as you go along. You don't go looking for them. You find the insights and then you make decisions upon it. But the main things to track of like a decay of an edge, your own performance, is just journaling the key metrics: rate of return, win rate, trade frequency, the dynamic win rate, I said, of TP1, TP2, break-even rate. Once you have a count of all of these things, you know your norms. And then I tend to look back on let's say a 10 trade sample size. So I'm not going to look back at the last 100 trades and say, all of this information, what do I do? I'm also looking at another data set, which is my recent relative performance on the last 10 trades or so. And then I'm comparing it upon my long-term performance. How is my short-term performance? Because the insight here is I might have had a hot period and now every metric is up. My P&L is up, my win rate is up. And I realize, my recent performance is here, but my general performance is here. I know I'm not going to outperform my edge, so it will regress back to this mean. So then I can also put safeguards in place and say, this hot period is not going to last forever. This is a recent high, and it will regress back to my normal trajectory. Same for a low period. If I'm having an abnormally low period, I'm not going to panic because I know it'll come back to my normal trajectory. So it's like having a North Star. You deviate away a bit. You look up at the North Star, I need to go back here. And this is a nice adjustment to have as well, which is why I track them both.
To complement what you're saying as well, let's say 3 more data points that I've heard you share, which I found very interesting. Your break-even rate should be more than your win rate. If I'm not
In my way of yeah,
Right.
actually, yeah.
So you're
Better wording is probably just saying a high rate of break-even trades for me in my style of trading is a positive sign.
correct, and that's kind of one thing you would only know if you would track your data, and that's kind of like a data point that you've.
The reason I made that a data point for myself is a lot of traders don't break even, and there's no cost to break even.
Right.
But the ability to break even quick, and on an A+ setup, some trades I'm breaking even within 3 minutes.
Right.
I do a very aggressive break even on the M1 shift, but this is only because I don't trade a 30 pip stop loss and a POI. I trade inducement, lower time frame confirmation, time window. So the inducement gives me volatility. Time window gives me volatility. Confirmation gives me it's ready. So I can time the market with volatility. So if I don't get an immediate reaction, this is a negative sign for my edge.
I'm breaking even.
For someone that is a swing trader, they are not timing the market in the same way. They might get in on a Monday and then the market starts to move on Thursday. So the break even is not appropriate for them.
Right.
But what this unlocks for me is if I can break even very quick and I aggressively do it without shame, it allows me to get trades that I was wrong in. Because now I can take a trade, and it's happened to me. I've said it many times. In the public signals, it happened. I took 3 trades in the week. All 3 of those trades went into a bit of profit and then melted on me. And I got the direction bias wrong. I got the market read wrong. But I was able to either catch my 1 to 3s or those losses just ended up being 3 break-even trades. So if you are able to be wrong in the market and take no loss, or maybe even walk away with a slight profit, this is a hack. This is a superpower in the market. And if you break even in the way that we have learned, which is consider your commissions, consider your spread, you have no cost to make profit.
Right.
This is a huge reduction in exposure in the market, which is why I do it aggressively.
Right, perhaps maybe the significance of that specific key point would vary depending on strategy, but I think considering break-even rate as a metric in the first place, I found very interesting. So that's point number 1. Point number 2, I remember you also mentioned the data point of how often is it that you get stop hunted by half a pip and then price goes in your direction anyway, compared to just getting destroyed, like you've mentioned, just beep and then melts against you. And I think, like you've mentioned, a good edge should have the latter more often of like you're just reading the market wrong, and that's just a normal loss compared to getting stop hunted.
Yeah, I did make a tweet about this last year.
Yeah, right. And I remember that.
I was basically saying, like, would you rather, I just put a question out there, would you rather hit stop loss and be totally wrong?
Right.
Or would you rather hit stop loss for 2 pips and then it goes towards your profit level? And a lot of people were saying, I'd rather be right. I'd rather hit stop loss and then it goes to my profit. I knew it. Yeah. At least I got the market really right. And that for me doesn't make sense.
Right.
Because when you get it wrong, you should get it wrong. And it's happened to me twice in the last year. I made a YouTube video about it where I hit stop loss on a public signal, I think. And it was a public signal, and hit stop loss for 0.5 pips. Right. And I factored spread into my stop loss. So there was a slight buffer there. If I hit stop loss for a couple of pips, the comment sections were full of, why not just give yourself a bit more breathing room? You don't need a 4 pip stop loss. I'm completely against that. Why would I now increase my stop loss by 1 or 2 pips, which doesn't sound like much, but when you're an intra-session trader, if I average a 4 pip stop loss, 2 pips extra is a 50% increase in my stop loss size, and therefore a 50% reduction in my ability to hit TP1 because TP1 has now moved further. So now why would I reduce my ability to hit TP1 or the rate I hit TP1? Why would I reduce the ability to make profit in the market to avoid a circumstance that happened twice in the last year? So you don't take decisions based on every insight. You look at it to say, I hit stop loss by a pip. That's very frustrating. How often do I hit stop loss by a pip? Oh, only twice in the last year. So let me preserve my win rates. Let me preserve the ability for me to hit a 1 to 3 risk reward within 12 pips instead of me having to hit a 1 to 3 risk reward in 19 pips or 18 pips or whatever the maths is by increasing my stop loss by 2 pips. Right. There's not a mathematical edge here. So I allow this and I consider a cost of my trading, which is 1 to 2 a year. I'll get wicked out. It'll hit my TP. But more often than not, when I hit stop loss, it's because I got it wrong. And I'm okay with that.
And I guess it also just cancels out when you look at the whole sample size of like, yeah, I didn't get stop loss. I did get stop hunted here, but across, like you've mentioned, 100 trades, I'm going to make less money overall. And my P&L
I think this is a nice reflection on year 1 to 3 of trading.
Right.
I would have been very reactive to that insight. I took a loss. It wakes me out for 2 pips. Let me just give myself a 2 pip buffer next time. And not knowing that the next trades, I could have hit profit on them, but I didn't because my risk reward profile has now changed. and therefore the loss that I took that was going to be recovered in the next trades,
It didn't.
it no longer recovered for me. So you messed up everything just by not knowing how to react to your data.
It's also important to know that this doesn't apply for all ledgers. Sometimes you maybe need a breathing room. For example, if your stop loss was 1 pip, then maybe you do need it to make it 3 to 4, 5 pips, whatever.
Exactly. So I don't take 2 pip stop losses, because even though sometimes on M1, the trade that the market is telling me I should have a 2 pip stop loss just for the sake of spread, logistics, whatever. My lowest is 3 pips. So if I on M1 get a 1 pip stop loss, which sometimes happens, I will not take an M1 trade. I'll take an M3 trade, and I'll just give myself my minimum 3 pips and my maximum 7 pips.
So this is all just based on gathering the data, reflecting on it for long enough for you to understand trends, and then making decisions. And that's what I think is very important.
Yeah, sometimes data analysis is not like, what's the data today? What's the inference from it today? Sometimes it's you're collecting data for months, and then an idea comes to you, and then you act upon it. Hence what I mentioned at the beginning of this episode of how I'm now modulating my TP1 and 2 based on the trade type,
Right.
which is a recent insight.
One more, let's say, topic I'd like to discuss as we wrap up the episode. It's a topic of agency, and we previously touched on it before. And it's something I really enjoy. Of like people with high agency, you can think of them as happening to life. They act their will on life. They move through life. And people with low agency, just life's happening to them, and you're sitting there and just waiting for things to happen. And there's 4 signs of a person with low agency, and I'm looking to, let's say, dissect each point of the low agency signs or traps and reflect that onto the markets. So for the sake of communication and making things easy to visualize, let's envision yourself, or let's say myself, I'm stuck in a South African prison in a deserted island, and now I'm going to contact someone with low agency, and he's going to exercise one of these 4 traits. So the first trait is the vagueness metric, or the vagueness trap of being a low agency person. So I'm stuck on this island. Yo, Waqar, how's it going? Any plans on come rescuing me yet? And he's like, yeah, man, I'm making progress. Oh, beautiful. So when are you coming? No date yet, and no specific plan of action yet, but I'm making progress, working on it, bro. I'll be there in no time. And you check in again in a year, and the second year, nothing changes. It's just too vague. And I think that's one of the traps, easy traps people can fall into that would lead them to be a low agency individual. So how can that be reflected onto the markets, for example? What is something that people are just way too vague about? Of like, I don't know, maybe I'll backtest, but what does backtesting mean? Or maybe I will work on my psychology, but what does that mean, for example?
There's probably a more perfect answer, but just what's first jumped into my head is something I mentioned to my members recently. I'm going to put a heavy asterisk here and say, if this applies to you.
Okay.
And this applies only to people that have a net worth of more than like 15 grand. If you don't have access to 15 grand, or you're not able to make 15 grand in savings within a couple of months, this advice does not apply to you. But if you're someone that is at a decent level of financial stability, a lot of people get into the habit of, I'm going to backtest for 6 months, I'm going to study for 6 months, I'm going to learn, I'm going to attend community calls, I'm going to ask questions, and I'm going to learn. And then I'll do my first prop firm challenge in 6 months. But you can afford to do 10 of them today. Now, it doesn't mean you do all 10 of them today. I'm saying your budget and your plan of action doesn't make sense. Because if you can afford to buy 4 challenges and it doesn't hurt you at all financially, buy one, blow it, and learn the lessons. And then buy the next one. You will probably blow it and learn the lessons. Your rate of progress is going to be so much faster when you're actually taking trades and losing money. And the blowing, I think people, if you have a baseline of information or baseline of knowledge, you will learn more in blowing accounts than asking someone that is a great trader questions, because you won't know what to ask them. But if you blew an account and you took these 4 trades, you can go to them and say, hey, I took these 4 losses, teach me. And you will learn more. So you'll learn more, you'll know more about your emotions, you'll know more about your personality and temperaments and the adjustments of exposure therapy, emotion therapy. You benefit from all of them, and you don't harm yourself financially. And a lot of people will just be stagnant and say, I'll take a prop firm challenge when I'm ready, not realizing the prop firm challenges and blowing them will make you ready.
Yeah.
I finally have a special offer to share with all of you from the US or my futures traders, which is over 20% of the listeners of the show. And that is Alpha Futures, a leading futures prop firm that is working with Trader 8 and Ninja Trader that are compliant with CME regulations. with the largest end of day balance drawdown in the industry, a 90% profit split and same day payout, and with the most competitive pricing in the industry, with accounts starting at just $79. On top of that, just by being a viewer of the show, you get up to 40% off all evaluations. So why not get started with an evaluation right away, trading $50,000, $100,000, and you already know the power of prop firms and larger capital. So go ahead and use the link in the description or code TOT for the best prices in the industry plus the best discounts in the industry to make this a home run offer if you are a futures trader.
I think you've given a very interesting answer because it ties into 2 points of the vagueness trap and also a different one called the midwit trap of like, okay, any plans on coming to rescue me, bro? Yeah, bro, I'm doing my 3rd year of now studying how to break people out of jail. I'm getting my PhD. And then once that's done, I'll take a course about it and then I'll come rescue you. Of like just taking way too many steps when you can just get started and then that will teach you how to get started. So now that's 2 points covered. There's a third one of cynicism of like, hey bro, any plans on coming to rescue me from this island? Yeah, man, I had a perfect plan. I posted on Reddit and a guy called Monkey Trader 341 made fun of me and just clowned me in the comments. And I think it's a bad idea now. I'm just not going to do it, man. It's just not for me. I'm not meant to do it. And just hang it up and you're left there. And I think that's also applied in the markets of like, maybe I take a few losses here and there and trading is not for me, or I just not cut out for this, for example.
Yeah, I think environments matters. And I had those voices at university when, my peers, my friends, they were aware I was trading. I was making no money. I had, I was only losing money. And then rumors would go around saying, oh, Waqar's trying to be a trader. If I had listened to those voices, then I might have given up. So it's also, as you're saying, it's knowing who's worth listening to. And some guests on this show are more worth listening to than your parents, because your parents don't know anything about trading. They have your best intentions at heart, but they don't have the full context. So their good-willed advice may steer you in the wrong direction. And a guest on this show who has context may give some advice that can change your life.
Yeah, I think it's qualifying the people you listen to first before listening to them. Let's say a lasting question to wrap up with. I really like this frame of thinking of like, what is something that you believed and thought of and looked to exercise in your first few years in the markets and only recently has changed, fully flipped? Something the markets has taught you that's changed your, let's say, prerequisite.
That is a level 10 question.
Yeah.
On the fly, I don't think I'll be able to come up with an answer. I'll have to think on it. Something that I've believed up until recently. Well, I mean, I've spoken about it today of the recent insights of the losses in a row and so forth. So I'll probably stick with that because I won't be able to. I don't have something that comes to mind on that one. One thing that I can say though is for someone that's made it to the end of the show. So I made 7-figure investment into stock markets. We mentioned it a few episodes ago.
Right.
And now, 2 months later, we're back at all-time highs. So it was an amazing V-shaped recovery.
Right.
So some of my Tesla trades are like 20% up. Some of my initial Meta trades are 30% up. Some of my best positions on the S&P or Halal that I took, they're like 12% up. But my average portfolio is up, I think, 11% or 10%, something like that. Mm-hmm. Aggregating multiple prices and how heavy I went in and etc.
Right.
That money didn't come out of thin air. That big investment that I made. So yes, I was sitting on a lot of cash. I tend to sit on a lot of cash, which is a mistake of mine. Mm-hmm. But also what I did was I realized, let's just call it, I had $1 million in my trading account and I'm doing 1% risk or 0.5% risk. So that means 900,000 goes unused. And because I'm not taking 20 trades at the same time, I also don't need that much free margin. So majority of the money in my trading account is serving no purpose. It's dead money. So if I have a $1 million account or $500,000 account, my working capital will be the same. So why not put $500,000 into the market and the other $500,000 into investments, but only if I have access to that money and it's liquid and it's unlikely to collapse, like a meme coin. So right. For example, if I put $500,000 into the S&P, it's stable, it's reliable, and it's very liquid. Mm-hmm. Now, if my account goes into a negative, my trading account goes into a negative, I can top it up because I have access to the money and the money is growing. This gives me mental peace because now I can see my account is growing without me working. And a trader's arrogance is I'm going to trade my money because I think I can beat the market. Why not use the market, let it help you, and then have working capital to beat the market? So I just realized if I'm doing 1% risk per trade on my, let's say, $1 million account, why not have a 100K account and do 10% risk per trade? And the other 900,000 I still have liquid, and maybe that's growing at a 5% to 10% a year. So I'm now gaining profits, which I might be down for a week, but my P&L on my portfolio might be up. And my risk in dollar amounts is the same. It's just I've modulated my overall portfolio in such a way where it's favorable. And that's what I did.
I think it's also powerful to not exclude yourself, and I'm speaking to the listener, from anything to do with investing and with doing anything to do with just compounding your wealth, even if it's very, very small steps. I myself also joined you in that move, and even though I am not as far into my journey or with the capital that I have access to, it's still a meaningful step, and it was still a meaningful return, and it was still a positive feedback loop that was enforced, and it led me to take bigger and bigger and bigger steps. And I'm probably going to look back at this 5, 6, 7, 10 years from now and be like, I'm glad that I did this, and this is going to be something that's useful. So if your net worth is 10, 20, 30 grand, it's not a couple million, don't exclude yourself from that. Just put $100 here, $500 here,
Yeah, just
a
to do the
grand
maths, so we can end the show on this. No matter your financial level, most people can afford £100, $100 a week. Maybe not right now you can't, but in your 30s, 40s, 50s, you probably can. If you from the age of 25 to 60 can do $100 a week, your net worth will be 1.6 million. You will be a millionaire if you do $100 a week. It might be hard in your first few years. At some point, it will be effortless. At some point, you might even do $200 a week. Everyone can be a millionaire if you just invest soon enough.
Even though it's unsexy to be a millionaire when you're 60, let's say now you start to make more, you can put in more. You don't have to do 100. It's not a hard limit. If you now can afford to do 500, you can do more than 500. Do that, and you'll be a millionaire sooner. It's almost like a guaranteed thing, and I think it's a powerful message to end on. But bro, thank you for this beautiful episode. I'm sure the people enjoyed it.
Boom.
There you go.